If you have £100,000 sitting in a bank account right now, maybe from a house sale, an inheritance, or the tax-free lump sum from your pension, you have probably already heard the standard advice. Invest it all in one go. The research says a lump sum beats drip feeding it into the market roughly 68% of the time. That statistic is real. But it was built for someone with 30 more years of paychecks ahead of them, not someone counting down to retirement. If you are 55 to 65 and the market drops 20% the week after you invest your whole pot, you are not looking at a dip you will shrug off. You are looking at sequence of returns risk, and it can cut your retirement income for good, even after the market fully recovers. The bit nobody puts in the headline is this: that 68% figure has no age built into it. It does not know whether you are still earning or about to start drawing income out. Once you are taking money from that pot instead of adding to it, the maths changes completely. So if part of you has been hesitating, holding that money in cash instead of firing it all into the market, that is not you being irrational. That is you sensing a risk the standard model was never built to measure. In this video, I will show you why the lump sum versus drip feed debate is actually a trap once you are within a few years of retirement, and I will walk you through the cash buffer rule, the approach that lets you invest properly without lying awake, wondering if you have just made a £100,000 mistake. If you are trying to protect decades of saving while the state pension age keeps shifting under your feet, subscribe to Arthur's UK Retirement Guide. We deal with the maths that actually applies to your 60s, not your 20s. The study behind that 68% number comes from Vanguard, and it is worth understanding properly instead of just quoting the headline. Across UK, US and Australian markets, investing a lump sum straight away beat drip feeding it in gradually roughly 68% of the time by an average of around 2% over the following year. That is a real edge. It is also almost beside the point for you. The edge exists for a simple reason. Markets go up more often than they go down, so the longer your money sits in cash waiting to be invested, the more time it spends missing out on those up years. That is true, but it assumes you have got time to wait out a bad stretch if one hits right after you invest. At 30, you do. Your next paycheck refills what the market takes. At 60, with no more paychecks coming, you do not have that same repair mechanism. There is a name for this shift. When you are still working, economists call your future earnings your human capital, and it acts like a shock absorber whenever the market wobbles. Once you retire, that shock absorber is gone, and all you have left is financial capital, the pot itself. That is the real line between an accumulator and what is sometimes called a decumulator, and it is a line the 68% statistic completely ignores. I have watched this happen to people who did everything by the book. They read the same research everyone quotes, invested their whole pot the day it landed, and then had the bad luck of a rough first year. Picture £100,000 going in as a lump sum. The market drops 20% in month one, so you are sitting on £80,000. If you are retired and drawing £5,000 a year to live on, that £5,000 now comes out of an already smaller pot. To get back to your original £100,000, the market does not just need to climb 20%. It needs to climb around 25% and cover the £5,000 you have already taken out. That gap between what you lost and what you need to recover is the real cost, and it is permanent if you are forced to sell while the pot is down. The invisible cost here is not the crash itself. It is that a crash in year one of your retirement can permanently shrink the income that pot is able to support for the next 20 or 30 years, even though the market eventually gets back to where it started. And most people miss the real twist. In the UK, this decision was never purely about market timing anyway. It is being shaped by HMRC and your ISA limits before you even get to choose. In the UK, you cannot simply move a large lump sum into a tax-free wrapper in one afternoon. The ISA allowance is capped at £20,000 a year, and the pension annual allowance sits at £60,000, so anything above those limits has to sit somewhere else first. usually in an ordinary savings account or a general investment account. Plenty of people wait there far longer than planned, telling themselves they are waiting for the market to feel right. Meanwhile, the full new state pension now sits at £12,547 a year, and your personal allowance is frozen at £12,570. That leaves a gap of just £23. Any interest that lump sum earns while it is parked in an ordinary account is very likely being taxed at 20% or 40%, on top of whatever the market does. I used to tell people the entry point was the whole game, that timing the market mattered more than anything else. I was wrong about that. For a lot of UK retirees, the tax drag of leaving money sitting in an unwrapped account quietly costs more over a few years than a bad month in the market ever would. Picture the same money sitting in an ordinary account, earning 4% interest a year. If you are a higher rate taxpayer, close to half of that interest gets sent straight to HMRC before you ever see it. Move it into an ISA instead, and every penny of that interest or growth stays yours. Which is exactly why waiting for the right moment in the market can quietly cost more than the crash you were trying to avoid. So instead of choosing between all in and all cash, there is a structure worth using, sometimes called bed and ISA. First, if you still have relevant UK earnings, use your pension annual allowance, because a pension contribution gets you tax relief of 20 to 40% immediately before the money has done anything in the market at all. Second, whatever is left sits in a general investment account and gets moved into your ISA in stages, up to £20,000 each new tax year, starting on the 6th of April. That is the bed and ISA approach, shifting money from a taxable account into a tax-free one, a slice at a time, year after year. The part that is easy to miss is that every year you delay moving money from that taxable account into your ISA, you lose that year's allowance permanently. It does not roll over. You cannot go back later and claim last year's £20,000 in a future year, and this year that allowance matters more than usual. From the 6th of April 2027, the cash portion of the ISA allowance for anyone under 65 is being cut to £12,000. If you are 60 today, the 2026 to 2027 tax year is your last chance to put the full £20,000 into a cash ISA. But should that money even go into cash or into stocks? That is where the real decision sits. There is an approach that actually solves this, instead of forcing a choice between all in and all cash. Work out what you need to draw each year on top of your state pension. Say that is £10,000. Keep 3 years' worth of that, £30,000 in cash or short-dated gilts. Invest the rest, in this example £70,000 as a lump sum. 3 years is not a random number. It is roughly how long a typical rough patch in the market tends to last before recovering, so it gives your investments enough breathing room to bounce back without you ever needing to touch them while they are down. This works because it removes the one thing that actually destroys a retirement pot, which is being forced to sell investments while they are down. If the market drops 20% the day after you invest, it genuinely does not matter to your day-to-day life because you are not selling those investments for years. You are living off the cash buffer while the market does whatever it is going to do. You do not need anything complicated for this. A simple, easily accessible savings account, a cash ISA or NS&I premium bonds all work, as long as the money is somewhere you can reach within a few days, not locked away for years. The goal is not the highest interest rate. The goal is money that is there, untouched by market swings, the moment you need to pay a bill. This is what solves what is sometimes called regret asymmetry. The pain of watching your invested pot fall on paper is much smaller once you know for certain you will not be forced to sell it to pay your bills this year, or next year, or the year after that. It helps to remember what this money is actually for. A 65-year-old man in the UK today has an average of 18.3 more years ahead of him, and a 65-year-old woman has 20.8. You are not investing this money for the version of you that exists this year. You are investing it for the version of you that is still around at 85. A typical bear market, The kind where the market drops sharply and stays down for a while, lasts around 289 days on average, well under a year. 3 years of cash buffer covers that more than twice over, with room to spare even if the recovery takes longer than usual. That is the theory. But what actually happens to someone who ignores this, and the worst-case scenario really does hit? Let us run the numbers. Picture two people, both retiring this year with £250,000. Both invest the full amount as a lump sum on the same day into the same global equity fund. Then something like 2008 happens again, and the market drops 30%. The first person watches their £250,000 turn into £175,000 almost overnight. They still need £1,000 a month to live, so they start selling units to cover it, right at the bottom of the market. Each sale locks in the loss permanently, because those units can never grow back once they are gone. That pot never fully recovers, and by 78 they have run out of money. The second person set aside £30,000 in a cash ISA before investing the rest, using this year's full £20,000 allowance, plus some carried over from the year before. Their invested pot still drops, down to around £154,000, but they do not touch it. They spend from the cash instead, month after month, while the headlines stay grim. By 2029, the market has recovered, and their portfolio is back above £250,000 because they never had to sell while it was down. Both of them read the same headlines that year. Both of them felt the same knot in their stomach watching the news. The only thing that changed the outcome was which one of them still had a choice about whether to sell. I remember talking to a gentleman in Surrey who did exactly this back in 2022, when both bonds and stocks fell in the same year, which almost never happens. He did not have to cancel his grandson's wedding gift because his buffer was sitting in a plain NS, and I account the whole time, completely untouched by what the market was doing. He told me the hardest part was not touching the invested pot at all, just letting the headlines run without checking the balance every day. The only real difference between those two people was not skill or timing or how well they picked their investments. It was whether they had 3 years of cash sitting between them and the market's worst month. So how do you actually set this up, starting tomorrow morning? There is a reason this feels harder than the maths suggests it should. Psychologists call it negativity bias and regret aversion. We feel the pain of a loss roughly twice as strongly as we feel the pleasure of an equivalent gain. So the fear of being the unlucky one who invests right before a crash weighs far more heavily than the appeal of the extra 2% you might earn by going all in. It is completely normal to feel that way, and with the state pension age now moving from 66 to 67, it is reasonable to feel more protective of what you have already built. The goalposts genuinely are moving. That feeling is not a character flaw. It is your brain doing exactly what it evolved to do, long before anyone had a pension to worry about. The useful move is not to argue yourself out of that feeling, it is to change the question you are asking. Instead of asking when is the best time to buy, ask how much cash do I need to feel safe enough that I will never be forced to sell. Once that number is sitting in your account, the rest of the decision gets a lot calmer, because you have already handled the part that was actually keeping you up at night. It also helps to shift some of your focus away from market returns and toward tax returns. A 40% tax relief on a pension contribution is a guaranteed return, in the sense that it happens the moment you contribute, regardless of what the market does that week. That is not something market timing can ever compete with, and it does not require you to guess anything at all. That extra caution is not weakness. It is exactly the instinct that keeps people from making an irreversible mistake at the worst possible moment. If this makes sense, here is how to put it into practice this tax year. Start by working out your income gap, meaning whatever you need each year beyond your state pension of £12,547. Next, carve out 3 years' worth of that gap and move it into a cash ISA before the 6th of April, 2027, while you can still shelter the full £20,000 a year in cash. After that date, the cash ISA limit for anyone under 65 drops to £12,000, so this tax year and next are the ones that matter most. Then take the rest and invest it as a lump sum, spread across a low-cost multi-asset fund rather than picking individual shares, so you are not relying on any one company doing well for the plan to work. This is not about chasing the best possible return every single year. It is about making sure the plan survives contact with a bad one, so the good years further down the line still have a pot large enough to matter. If you still have relevant UK earnings, look at your pension annual allowance too. Up to £60,000 a year can go in, and the tax relief on that contribution alone is often worth more than anything the market could do for you this year. Finally, set a reminder for the 6th of April every year to move another £20,000 from your taxable account into your ISA. It is a small habit, but skipping it even once means losing that year's allowance for good. It does not carry forward. If a structured approach like this feels more solid than trying to guess where the market goes next, hit subscribe. There is more of this coming. Lump sum investing wins the maths battle. Over enough time, putting your money in all at once usually beats drip-feeding it in gradually. But the cash buffer wins the retirement war because it is the version that lets you actually stay invested when the market gets ugly, instead of forcing you to sell at the worst possible moment. You have spent 40 years building this pot. Setting aside a buffer before you invest the rest is not giving up on growth. It is the insurance that lets you keep that growth instead of losing it to bad timing you never saw coming and never could have predicted. The best strategy was never the one with the highest number on a spreadsheet. It is the one that lets you stay in your seat when things get uncomfortable. Because that is the only strategy that actually gets to finish the race. None of this requires predicting the next crash or guessing when the market will turn. It only requires deciding in advance how much certainty you need before you can sleep at night. That decision is one you get to make today, on your own terms, long before any headline forces your hand. Subscribe for more retirement logic built for the UK. I will see you in the next one.